For more of the markets, as we count down to the CPI data at 8:30, let's welcome Ron Temple, Chief Market Strategist for Lazard's Financial Advisory and Asset Management business. That's a heavy load, Ron. That's broad shoulders. So the buck stops with you at Lazard, right?
Well, I think it might stop with the CEO, but thank you.
we know that guy. You're not feeling that disturbed or distressed. You think the soft landing, unlike Jamie Dimon, you still think that's likely, and 0 rate cuts this year would be very surprising to you?
Definitely. I think the probability is we do have a soft landing. The economic data looks good, but what's important to me is you see easing of tightness in the labor markets. The inflation report in January clearly was a big surprise. Today's number is really important. But when I look at the data over the last year or more, I see decelerating growth, less inflation pressure, and effectively what I've been calling an immaculate disinflation. Let's see if today's data proves that to be right or wrong, but I do think we're on a good course.
What are you expecting today? In line, or could it even be softer?
My base case is it is in line, basically. You look at last month, we got 39 basis points. The consensus for core this month is 31 basis points. There were a bunch of moving parts last time. Last month, we shouldn't forget, used car prices were down the most since 1969. That subtracted 8.5 basis points from core CPI, so the number is actually a bit uglier than it looked on the headline. But on the other side, we had elevated inflation related to shelter that most people don't believe really accurately reflected the story. So all of that leaves behind services excluding shelter, which were shockingly high at 85 basis points month on month. So that annualizes at over 10.5%. Doesn't fit any of the other data I see. So I'm expecting that to come in this month. So long story short, I think 30 basis points seems about right. If we do get an upside surprise of something like 40, May's already off the table in my view for a rate cut. That could really bring questions around June.
Yeah. You think inflation continues to cool? Do you think the economy is decelerating?
Yeah, I think the optimism has gotten overdone on the economy. If you go back to October, the consensus for GDP growth this year was 50 basis points. It's now 210. Now, I look at it, and yes, the consumer's been more resilient, the corporate sector's been more resilient, but let's not get out over our skis here. I mean, there's a lot more pressure on consumers. The excess savings that help support spending for the last 3 years are largely depleted. And again, when you look at the job numbers, the quality of the job creation has started to deteriorate. So I don't think we should be assuming another 2.5% real GDP here. I'm kind of more in that 1.5% camp. So not there with Jamie Dimon on soft landing being questionable, but I don't think we should be expecting, exuberant growth this year.
The stock market could be where it is right now based on the scenario that you've described, which is a very positive one. We may be in the market already, or you don't think so?
Yeah, I think there could still be some upside. What worries me is I think a lot of people are assuming that when the Fed starts cutting rates, you're going to get lower long-end rates, that the 10-year yield is going to come down materially. I actually think the 10-year yield has already given you all of the benefit you're going to get. 4 to 5% is my kind of fair value on the 10-year, probably closer to the high end of that. And by the way, if we look at the deficit forecast coming out of D.C. for the next decade, I think there's going to be increasing pressure on the upside.
You saw that today. Those are horrific. If this budget's not going to become law, but if it did, we're at 105, 110% of debt to GDP for forever, and we've never been there forever before.
And honestly, we all know this budget is a signaling tool for politics, but regardless of who wins the election in November,
it still happens.
I think you're going to have deficits to GDP at 6% or more every year for the next decade.
Right, which is in this budget and in
it's a problem.
In the other guys.
It's not sustainable.
Budget probably. Election year make you happy, sad? It doesn't matter.
I look forward to it being over.
Yeah, we're all set. But in terms of the markets, you don't think it either helps?
I don't think election year has an impact on markets. I also don't think the Fed changes policy based on election years. I think if there's one institution in D.C. that's desperately trying not to be politicized, it's probably the Fed.